All right. Hey, everybody. Saving the best for last here. This is really the most topical panel of the day. The topic is lending, the linchpin of all real estate. And as we know, it's hard to get money these days. A lot of people need it. Give me some money, investors and developers are saying, especially the ones that are in trouble. But a lot of the big banks are frozen. Regional banks not doing much if they're still in business. And I heard investors say recently that you can call up your banker, you can ask about his kid's soccer team or where his family is skiing this winter break, but don't ask about money. So fortunately, there's some private players filling the void. I have them up here today. And they expect to see more opportunities in 2024. So we're going to hear about that. And I want to get a show of hands. Who here is in commercial real estate? Okay. Who here is in residential real estate? Okay. Looks like majority in commercial. All right. That's what I wanted to hear. Just trying to decide how in-depth and in the weeds to go. So I just want to introduce these guys. We have Holly MacDonald-Korth. She's the CEO of KDM Financial. So Holly officially took over the reins of the family business, which holds around $500 million in loans back in May. One of their interesting products is a fixed-rate loan that's not exactly long-term traditional debt, but not hard money type loan either. So we're going to see what Holly's most interested in investing in today. Next is Alex Horn, right there, the founder of Bridge Invest. Pretty active these days. Since founding a dozen years ago, they've done about $1.6 billion in financing. And to give you a sense of how many deals these guys have to sort through, Alex was mentioning he's reviewed something like 40 billion in deals this year. So we're going to hear what that looks like next year and how a lot of those pencil out. Finally, we've got David Moret of Highline Real Estate Capital, closest to me here. And they just launched a $350 million distressed fund targeting office, retail, multifamily, and industrial. David was a court-appointed receiver at one point earlier in his career, so he knows his way around troubled properties. And they're more in the operator, equity investor space. And obviously David thinks it's the right time to pounce. So I want to start off with a question for you guys. Do you have any horror stories from the big banks or regional banks, like just showing just how tight lending is today? Like, what are you seeing from, some of the traditional lenders out there as far as availability of capital?
Stuart, can you just repeat that first part of the question?
Sure. Yeah, just in terms of like the traditional banks and regional banks, what sort of like stories are you hearing about how tight lending is today from those banks? Like, is it, what are they asking for? How hard is it to get capital from, some of the traditional lenders today?
Sure, got it. Holly, you want to take that, or you want me to take it?
I'm a borrower if you want me to answer.
You can go ahead, and then I can chime in after.
We're on the operating, investing, and borrowing side, so we definitely deal with that. I mean, the banks that you're close with will tell you that they are trying not to lend right now. Yeah. They're at a point now where they're not getting the payoffs, and their balance sheet's growing because they have unfunded obligations. They've got construction loans. So, most of the bankers we talk to have really said that their focus right now is servicing existing customers who have significant deposits. Obviously, there are exceptions for first-class borrowers who bring significant new deposits. But the idea of, I need a loan for a new project, I'm going to hire a broker and go out and talk to 50 banks, you're not going to get many responses there. So it's highly relationship-driven, and I don't want to say it's frozen because that's an exaggeration, but it's incredibly constrained.
Yeah.
Yeah, so to follow on that, what we've seen from banks, and both from our borrowers and from banks that we've talked to directly, is they want to use lending as a source of deposits. So they're asking for huge deposits because all the banks need to raise deposits because they have to have more capital. And generally, a lot of them are over allocated to commercial real estate, but they don't want to mark down their portfolio or get rid of things. So they're trying to bring on additional other asset classes and more deposits to lower their allocations. So we've also seen, our pipeline has been really full of people looking for financing because we've had people that were, at the closing table and their bank just called and said, listen, we've canceled all our commercial loans. And so, the lending conditions have gotten very tight. It's been good for us because we're seeing a lot more deals.
Yeah, yeah. I want to ask, you guys are all based in Miami, but you do deals all over the country. Are you starting to see more opportunities in South Florida? What is it looking like overall?
So we're definitely seeing a lot of opportunities here, and I think one of the things for us is that we're particularly fortunate to being down here, because even in this market where we've actually seen basically a pause on a lot of transactions nationwide, South Florida has actually still maintained its activity. Frankly, despite everything that's happening in the world around us, we're still seeing increased activity here of new acquisitions, refis, simply because there has been this mass migration to South Florida and a need for more properties down here.
Yeah. And you mentioned just in terms of deal volume or deals that you're reviewing, you reviewed 20 billion last year, you reviewed 40 billion this year. Like, what was the mix? How much of that was out of South Florida versus other parts of the country?
So we're nationwide. So we do have quite a bit of exposure outside of South Florida. I'd say Florida, we break it up by state. So Florida, we actually saw, I want to say it's like 40% of our deals were in Florida. The rest were throughout other parts of the country. The vast majority of what we've seen recently is in the Sun Belt states. So Florida, Georgia, Carolinas, Texas, and Arizona have seen huge growth. Those are markets where there's still an inflow of population, and as such, we're seeing new properties and deals that make sense. Sort of the stat that you quoted of, which is 100% correct. Last year, we looked at about $20 billion, or just over $20 billion of transactions to close in 2022. In 2023, we're over $40 billion, which gives you a little bit of the measure of the banks in the space and competition about how there's been such a big pullback. Mm-hmm. Now, the interesting part about that metric is that even though we're seeing a lot more transactions, it doesn't mean we're closing double the amount, because a lot of transactions just don't make sense today. We are in a position where there's a lot of transactions that were done in the last cycle that were maybe higher leverage than they should have been, or frankly, transactions that shouldn't have been done, and those deals are really hurting now. So there's a lot of deals that we are seeing coming down the pipe that will end up having some sort of distress or some sort of liquidation, mm-hmm. Because they won't be able to pay off their debt.
Yeah, yeah. And you're saying, I think you were saying before to me that, typical environment, you would review deals and maybe do deals on 2% of them, if I remember correctly. And right now it's like, 1% or...
Yeah, it's a little bit more, but yeah, correct. Like we typically have about a 2% conversion rate. Mm-hmm. This year it's probably like 1.5. So overall, we've done more than we've done in the past. Simply, there's just a need for alternative lenders with discretionary capital today. But it's certainly not one for one from years past.
Yeah. And Holly, you mentioned, some of the asset classes you're most excited about. I think you mentioned light industry, multifamily, office properties, all for very different reasons. But do you want to get into how you're thinking of those different asset classes?
So KDM is the way that we analyze a property is very bottom up. So we're kind of, open to all different asset classes, except hospitality, really, because we view that a lot more as an operating business and not as much as an investment property that's easy for us to go in and take over if things don't work out. Yeah. So we traditionally have lent a lot on office, light industrial, not warehouse logistics centers, more Class B, flex space, these kind of properties. I'm very bullish on retail right now. I think retail was pretty beat up for a couple of years. I'm not talking malls. I'm talking strip centers, open air retail, neighborhood shopping centers. I really like those. We are launching a multifamily bridge program that's not construction, it's more lease up capital. Mm-hmm. Mm-hmm. So lease up loans and for new or recently rehabbed properties. So we're kind of all over.
Yeah.
We will look at any deal that makes sense.
Yeah.
You know, that we think makes sense.
And light industrial, it's a little different because that's a hot asset class and not just owners who are looking to get money out, right? You were saying, but multifamily is a little bit more the floating rate debt guys that got in trouble, and then office, you know, you don't need to say too much about office. That's just because it's troubled.
Typically, our borrowers come to us when they need additional capital for a specific reason. So they need to do some kind of improvement for the property to improve the business, or because they have a new tenant coming on, or if it's a light industrial, sometimes they need equipment. We do a lot of like interesting kind of factories or people who are producing things, and they need, you know, another production line, for example, and so they've got a low basis in their real estate, and so they take out a mortgage to do that because the financing is more advantageous than taking out an equipment finance loan, for example.
Right, that's interesting. And David, tell me about what assets and areas you're targeting with your $350 million fund. Like what, I know we're targeting all the Southeast, but obviously Miami is a piece of that.
So we have great flexibility by asset class. What we're really trying to do is provide flexible, creative capital to solve issues. And you know, there are really two main drivers of value in both directions. There's the income and the operational side, right? As your NOI increase, as there growth, rent growth, and the negative side, obviously, OPEX increases, insurance costs. But the most significant issue we're all facing is really just the change in rates. If you did a floating rate deal, you know, 2 years ago today, you might have borrowed at, you know, 300 over SOFR or LIBOR at the time, and LIBOR is 15 bips.
Yeah.
So you borrowed for 3.15%, and you had a value add plan. That same money today is 9%. High 8. So you've seen almost 2/3 of your capital stack triple in cost. And so when you know those borrowers, and fortunately in Miami, the fundamentals have been tailwinds. But even putting that aside, there's still a math problem. The valuation has changed when 2/3 of your capital stack has tripled. And so what we try to provide is the capital solution for that whole. Now, so far, we see lots of deals where a borrower comes in and says, "Oh my, you know, I got a loan and then I need to pay it down by $5 or $10 million to get an extension and buy a cap and this, that, and the other." And there's a disconnect on value, right? Borrower thinks about yesterday's value. We believe what today's value is, and what ends up happening is the borrowers are able to go back to their lenders and get more time. The banks are still being pretty accommodating, and as long as the loans are paying, which they generally are, they're getting more time. But ultimately, there will be a day of reckoning where the deals have to be recapitalized.
Yeah.
And so we believe there's an opportunity to provide that capital to right-size the loan. And then the question is, you know, how good is the equity of the existing sponsor? Are they playing for a hope note in another day, or are they bringing in fresh capital that enables them to add value and recognize the upside they had hoped for from the beginning? So that's all playing out. I think we're very early in that process, and as long as rates are bouncing along the way they are now, I think there's just continued uncertainty, and we will continue to see muted transaction volume.
Yeah. Do you think the extend and pretend type scenario goes out longer if interest rates come down a little bit, or what is the driver that, you know, where the banks finally say, okay, enough of this, everybody gets beaten up and gives up, you know, essentially?
You know, I think what's different if you think back to the last cycle, and we really didn't even have, you know, we didn't have smartphones in the last cycle, but every Friday you'd wait to see what bank got taken over by the FDIC. And so we were dealing with banks that were dealing with loss share agreements and getting pushed into forced marriage. I mean, it was an entirely different environment. Going in this time, I think, certainly banks were much more responsible, and you think of general LTVs in the 60-65% range. And so once I think there are more transactions to provide data points on value, these banks are going to realize, let's put office aside for a second, that wait a second, we're money good.
Yeah.
I feel bad for my sponsor. They're going to lose some equity. Maybe not all of it, but they're going to lose some. And eventually, after trying to be a good lender and a good relationship bank and giving them extensions, it's going to be time to sell. And we are starting to see a lot of deals come to market labeled as lender-directed sales. It's not necessarily a short sale. It's lenders involved. We're going to go out. We're going to test the market and then decide whether It's an equity loss, a short sale, somewhere in between. So I think when lenders feel confident that their loans are good, they're going to say, why am I sitting around with this loan based on yesterday's interest rates at a leverage level I don't like, when I can push it out the door, sorry borrower, reissue it at today's rates at a better leverage level.
Yeah. So do you agree with Alex kind of assumption that 2024 is when you're going to see more deals, or it's going to take a little longer?
I think you start in 2024. I mean, if you look at the wall of maturities, 2024, 2025. I mean, think back to when the party really peaked, right? It was 2020. In 2020, we were in COVID. Things picked up at the end of the year.
Yeah.
21 was a party, and it slowed down in early 22. So most of those bridge deals were 3-year deals with options. So add 3 years to 21, and next year's a big maturity of the year.
Right, right. Well, let's talk about office a little bit more, because that seems like it's its own beast, right?
Everybody's favorite topic.
Holly, tell me, a little bit about kind of the parameters you're thinking about office. You had some interesting thoughts about it, like not wanting Fortune 500 tenants necessarily, wanting businesses where the clients actually had to come to the office space.
Yeah, so, it used to be a few years ago when we were underwriting potential office loans, we wanted credit tenants, household names with big square footprints. And since the work from home revolution, now when we're looking at office, we want those tenants to have already downsized. We want granulated rent rolls, meaning lots of small tenants of a couple thousand square feet versus big 20, 30,000 square foot footprints. And doctors, lawyers, accountants, dermatologists, like people who their customers need to come to the office. Because those are very sticky. They're small businesses. If they still have an office, it's because they need one and they want one. And then the other prong is new tenants who have signed leases since post-COVID. So, we closed a loan a couple months ago that has some household names, but all of the leases were signed 21, 22 vintage. And so that shows that they want that space. The space is the right size for them, and we expect that office to remain stabilized.
Yeah. So you're actually the tenants who are using the space and not just kind of warehousing it, right?
Yeah, exactly.
Like
there's bodies going into desks every day.
Yeah, that seems smart. Alex, you're doing construction loans, which, that's one of the riskiest bets in real estate. Walk us through some of the recent construction loans you've done and, why those make sense for you.
Sure. We're doing 100% office construction loans all the time. That's a joke. Do not call us about office construction loans. We are not doing any of those.
New office and
in fact,
Manhattan.
like for office and talking about construction in a second. What we always talk about in my team and what we discuss a lot is like avoiding, as a lender, avoiding binary outcome deals, which is a lot of what office is today. And this is why some of you that are going to your lenders and saying, hey, this is a no-brainer deal, like look at the upside. Those deals function very differently for lenders. For a lender, we're looking much more at deals that even if you can make sort of a 10x on buying office in the right time at the right moment, that's great for a borrower. But from a lender's perspective, you're looking at your capital base and how do you prevent getting impaired on your loan basis. And that's a hard part about office today is there are very few office deals that you can say, my base is not going to be impaired. Mm-hmm. We saw an office deal recently in fantastic market, institutional sponsor. They just completed building this project, and this was a takeout from construction loan. The office was being, our loan basis was at $60 a square foot, core infill, good location. And I said, this is attractive. I got to look at this. So it was vacant at the time. But then I pulled up the submarket specifics, and that submarket had 50% vacancy in office.
Oh. Uh-huh.
It's just hard to underwrite as a lender to say, hey,
yeah.
How can you take this risk? Like, yeah, if the borrower's correct, if our sponsor's correct, they'll make a lot of money. But as a lender, if they're wrong, like that's going to be tough. And there's no question that we're in a period of time where we're in a supply destruction mode for office. We need to hit equilibrium, and it's not too dissimilar to what happened in retail over the last 7 years. But we're going through this downsizing. So I understand that there are fantastic office opportunities out there for sponsors buying, but it's more difficult for the lenders.
Yeah.
And your question about construction. So on the construction side, we're really focused on 2 asset classes right now. So we like construction. We actually think that product type is really interesting. So we launched our construction lending platform in 2016. And it was really an idea of doing these loans where our sponsors are really aggregating value by building this project. Any developer will tell you that it's a lot of work. It's very tough to build a project, and you really create value. As a lender, we like that. It's an ability for us to kind of monitor the project, lend the money as the project goes, and at the end of the day, you end up with a project that's much more valuable. I think David was asking me before how our portfolio is doing, despite kind of increased rates. Unfortunately, knock on wood, I don't see wood around here, but knock on wood, we've actually been okay. Mostly because our development projects, the borrowers have really aggregated value. So in that respect, construction for us is really interesting. We like doing it in multifamily and industrial, rather housing and industrial. And housing for the simple point that we are missing about 4 million residences in this country until the year 2035. So there's a real need for more housing. So whenever we can play in that space of being able to do construction financing for multifamily projects, we do. And we do it as well for condo projects. So we're doing a project here called Indian Creek Residences that we actually closed recently. But we've also done kind of several other big marquee ground-up construction projects for multi and for condo projects. So that's one area that we focus on construction. And our construction sort of pricing and LTV ranges will do anywhere from about 70 to 75% of cost. And our pricing for construction is typically, it's all floating. It's SOFR 5 to SOFR 6. So all in today, you're talking about 10 to 11%.
Got it.
The second area asset class that we really like for development is industrial. We just closed 2 industrial deals, both of them in Phoenix. And this is really playing off or drafting off, number one, kind of consumer habits have changed since the pandemic and the need for more last mile logistics, not just for the consumer, but also as we see that companies are favoring supply resilience versus supply chain efficiency. So they want more of their assets here in the States. But also the geopolitical tension between the US and China has really forced a lot of companies to onshore and nearshore their manufacturing. So for instance, these 2 projects that we did in Phoenix, it's really benefiting from the massive boom in semiconductor development that's happening there. So Taiwan Semiconductors announced that they're investing $40 billion in a new manufacturing plant there, and Intel is investing another $20 billion, creating a lot of jobs and a lot of necessity for more manufacturing and industrial space in Phoenix, Arizona. So on the construction side, we're really looking for macro trends that we think are interesting, mostly in those 2 arenas, and in markets that we think are very valuable.
Yeah, and you think industrial has a lot of room to run in terms of it's not even close to getting built out, or I mean,
Well, so interesting stat. So between the years of 2000 and 2010, the U.S. Offshored about 1/3 of its manufacturing capabilities. We're seeing that come back now. So there is a lot of new manufacturing facilities and jobs being created in this country daily, and there's really not a lot of industrial properties for those to go to. So we think that there is still a very interesting trend there.
Yeah. And Holly mentioned hotels. Just won't get involved in that. Do you stay away from hotel too because it's more of an operating business?
So we're asset agnostic. We'll do kind of all assets, all asset classes. We do hotels. In fact, we have one signed up here in Palm Beach right now. And what we like about hotels is that it's more of basis. If you consider that hotels really during the pandemic, a lot of the bad hotels ultimately shuttered their doors and closed, and a lot of them had a very difficult time finding financing. So today we find that for good quality assets, usually select service, we can enter and we can do financing at a pretty attractive basis with a high debt yield. And really, for anybody looking at alternative lenders and trying to attract an alternative lender to do a project, our North Star today is debt yield. That's what we're focused on through and through. So for those that don't know, debt yield is effectively a cap rate, but on your debt amount. So when we can do transactions that we can go in with a going-in high debt yield, and to us that means anything from 8 to a 10% going-in debt yield, that's very attractive in any asset class we can do. So we find that a lot in hospitality and retail as well. So that's why we've done existing retail and hospitality deals recently.
We touched on this a little bit at the beginning, the notion of relationship banking, and if you're related, you probably have pretty good relationship banking. Like, what are your typical borrowers, in terms of size or track record and so on? And do you see yourself kind of edging up to deal with the even bigger guys who would normally do more of the relationship banking because they can't get capital? What does that kind of look like?
So typically, Bridge Invest, we focus on middle market transactions, so anywhere from 10 to 100 million. Today, where our average transaction size is about $30 million of loan amount. What we have seen is that there's a much bigger need for alternative lenders in what we do across a spectrum of the borrower mix. So we've been focused a lot on actually maintaining kind of our cost, or in fact reducing our costs and being more competitive with your traditional banks, and exchanging that for a higher quality borrower. So today our pricing, we'll do loans as low as SOFR 350, which is very much in line with kind of what you can find at your regional bank. Except we don't require deposit requirements, we don't have recourse on our loans, and we can just ultimately close a lot quicker. And that idea there is to be able to attract the institutional sponsors, which we've done with several marquee names, even some of the names that were here today, and do those and repeat transactions with those sponsors. Because ultimately, now I've been doing this for 12 years, what we've defined, what we know is bad borrowers always equal bad deals, and good borrowers can figure out a way out of bad deals.
Holly, how about you? And I wanted to ask you too about one of your products, the fixed rate loan. That seems like an interesting one. Can you kind of tell me what sort of niche that occupies?
What sort of niche? What? Sorry.
The fixed rate loans that you do. That seems like an interesting product, a little bit different from what these other guys do.
Our fixed rate product is very popular with borrowers. I think that borrowers, when they're running operators like to know how much their debt service is every month, and it's very easy to predict. So that's why they like it. We like it because the math is easy. We also have a floating rate product, but the fixed rate product is the most popular just for ease of predictability. You do run into interest rate risk on our principal side, where some of our loans, if I wanted to sell them or re-securitize them or something, then they're out of the money right now. But luckily, the vast majority of those are paying as agreed and will hopefully refinance in a couple of years. So,
yeah. And David, can you talk about how much you've raised for your fund so far, and who and how you're marketing that to? How does that process work?
Yeah, there's a discretionary component that's primarily made up of high net worth individuals, and the ultimate cap on that is 75 million. We have another over a year to complete it, and we're about halfway there. And then there's basically $100 million sidecar vehicle, if you will, with a series of larger funds that we've done repeat transactions with. And so for larger transactions, we partner with those larger groups. So that's about $175 million of equity power. But part of the strategy was to close out in the fund, or have the first closing be operational, which we are, and deploy and do a handful of investments, which we have several in the pipeline right now, and then continue the fundraising effort after the first of the year.
Yeah. What is a typical profile of the people that are investing in it?
Everything from, we've always operated under two different platforms. One was our value add platform, which we normally pursued in joint ventures with the larger funds that I mentioned. And then the other we called our long-term cash flow or evergreen strategy. And that was basically a friends and family model of buying shopping centers that we hold indefinitely. We have a portfolio of those assets around the Southeast. And so those could be people who are in private equity, doctors, lawyers, accountants, people in all different industries. Yeah. And then we really have several top real estate people that are invested in the fund on, who are really all disciplines, whether it's leasing, investment sales, finance, construction, development. So a lot of investors who we've transacted with or are friends with over the years, and we've done partnerships with, made investments in the fund. And we view that as a great two-way street because it provides us access to deal flow and information and expertise, and they believe in what we do.
How big of the investor pie is that, the real estate industry people?
It's probably 60. I haven't done the math specifically, but it's probably more than half.
Wow. Yeah. That's a nice tie-in. Yeah. For sure. Well, I wanted to ask you guys too, also like private lending with high interest rates was a bad word, back in the day maybe, but you were saying the perception of that's changed a lot over the years. Can you kind of speak to that?
So when I started the business in 2011, the term was hard money lender. And I think that the industry has done a really good job of differentiating the different type of lenders. And as a business, we made the conscious decision about 6-7 years ago to move as far away from that as we could. And the industry itself has also recognized that there are different lenders that fit different buckets. And at Bridge Invest, we've always kind of sought to be as close as institutional as we could to really try to be a bank alternative, however, do so without all the red tape. So the industry itself has appreciated. When I started, if you took money from private lender, you wouldn't tell your investors. Today, alternative lenders are a very real part of the ecosystem, and frankly are stepping in a lot of places and a lot of situations where these banks cannot or are unable to today.
Yeah, it does seem like a pretty significant shift in the perception of this, fixed rate, just the standard lending versus what you guys do. And Holly, I understand that you're putting together a CMBS deal now. That sounds like a brain damage kind of situation. Tell us more about that.
So we really position ourselves as a CMBS alternative. The CMBS loans tend to be very restrictive. They have, 10 years, or now there's a lot of 5-year ones, but 5 years locked in yield maintenance or defeasance, meaning if you did a loan right now at current rates at, let's say, 8%, if you wanted to sell your building or refinance in a couple of years, you owe the lender that 8% for the life of the loan, essentially. And the way that they come to that calculation of whatever you owe them is very complicated and a lot of brain damage. You also have to work with a third-party servicer and a lot of third-party entities. And, part of our, what we present to our borrowers is that we do everything in-house. So we're a vertically integrated originator, lender, servicer, and securitizer. And so through the life of your loan, from everything through closing your loan, we have in-house legal, to servicing. You're dealing with my team and our servicing department, and asset management. If there's problems, you're also dealing with us. So, you can pick up the phone and say, hey, I've got this challenge, or hey, I need, some flexibility on this or some additional funds for this, and, we can help you solve that problem together.
Yeah. And I think you were saying that office was traditionally 40 to 50% of a deal like that. Now you've got it down to 15% or so in the current CMBS you were putting together. Is that right?
Oh, yes. So, office used to be a huge proportion of CMBS deals that were coming out. It was 40 or 50%. of deals typically, and now they're trying to keep office to 10 to 15% of most CMBS transactions. Yeah.
I guess that makes sense. Well, it's interesting. One asset class that hasn't come up today at all with you guys that we've talked about all day is new condo buildings. Is that something that's like, what does that look like to you guys? Is that not of interest, and why, if not?
So we actually really like condos, and it's both from the inventory side. We actually closed a condo inventory loan in Atlanta maybe 6 months ago, and found that interesting. It's going and it's very successful. As well, in the beginning, I mentioned that we closed a condo construction loan, and that's something we're very active in right now because it's the condo market, especially down here, is less reliant on the financing market. And the margins typically tend to be higher in condo space. So we're actually actively underwriting both condo construction and condo inventory. Yeah. For us, for condo construction, we'll require some sort of pre-sales, but it could be anything as low as 20% pre-sales to 40% pre-sales is like where we usually tap out.
Cool. And David, I want to talk about your past. You worked as a court-appointed receiver in the past. Did that give you a lot of background or expertise to really do the distress fund later, or where did you kind of get that?
So prior to forming Highline, I was a principal at a group called Continental Real Estate Company, and we were a service provider. I ran our investment vehicle where we bought value add just like we do now, but we also had management, leasing, brokerage. And when the GFC happened, we started calling lenders and banks and special servicers and life companies trying to buy assets, trying to buy notes. And back then, you mentioned extend and pretend earlier, no one wanted to sell. And what we'd hear from the servicers was, we're going to take this property back, we're going to lease up the vacancies. And so we had this service business, and we started saying, well, let's at least, you might as well do something if we're not buying anything now. And so we pitched our services, and they needed basically a receiver to come in, because they didn't have the asset management capabilities either. So we'd come in, we'd do the, backfill the boxes that were vacant, stabilize the property, and then sell it. And what that led to was relationships that then enabled us to buy notes and REO assets as time went on. So, but yes, it definitely gave us, gave me a view behind the scenes at how those things work, and we were involved with all different asset classes, big patches of developable land, and some of those people have moved around, but some of those special assets people are now in the business at different places, kind of ramping up again. And I think, I do definitely think that's not our business. We're not a service provider. We're purely an investor. But I do think there will be a lot of that, and we are starting to see a much greater flow of note buying opportunities, many of which already have a receiver in place. So it's coming again, and it started.
That's cool. I mean, it sounds like you're plugged in a lot of different ways through your history, and then also having all those real estate investors, which in the distress space, that type of stuff really obviously helps. It's a whole ecosystem, right?
Every one of these cycles occurs differently, and you don't really know exactly how it's going to materialize. So yeah, just getting out there and being in as many places you can to see how people are reacting to, there's different strategies. The banks are thinking about one thing. I mean, we're seeing very different behavior from some of the banks. I think banks are worried about Silicon Valley, and they're worried that if any distress becomes public, someone could write a tweet on or an X or whatever you call it now, and hey, look at this bank's financials. So we're seeing banks being a lot more discreet in their disposal of loans. And I just think every bank's got their own set of circumstances they have to deal with. Some are bulk selling, some are using brokers, and some are quietly moving things out the back door.
Yeah. Well, I want to ask two more questions. One's a little farther afield, but I'm asking this in every panel today. This National Association of Realtors lawsuit, I don't know if you guys have been following it, where they've disconnected the buyer's broker from the seller's broker in terms of commission. What do you guys think of that lawsuit? Do you think it's going to affect broker commission? A lot of brokers in the audience today. What's kind of your take on it, if anything?
I'm not in that industry.
Yeah.
Probably not in a good position to opine on it.
So I'll speak about brokers in general. I think in today's market, and we see this a lot on the mortgage brokerage side, in today's market where finding the right capital solutions is difficult, the value of brokers, both from the mortgage side and from the sales side, are very, very important. It's extremely important to work with the right brokers, and a good broker is worth their weight in gold to be able to find the right solution for their clients. So to that extent, like in a market like today, that's an invaluable service and should be paid top dollar for it.
Yeah, the value of a broker in a good market versus a bad market is or a tricky market is a very, very different thing.
As long as a market stays fragmented, you need brokers, right?
Yeah.
So when the markets become defragmented and more disintermediated, then that's when the brokers are at risk. So, and this lawsuit that this decision that came out is very controversial, but and I think there will be more challenges to it. I don't think it's like a done deal, but I think that the writing is on the wall that there's going to be some change in, sales compensation. So.
Yeah, it's gonna play out for a couple other cases, it looks like. My last question for you guys is just in terms of your own internal business and staffing and everything like that. You talked about 2024 being active. Are you guys ramping up now in hiring, being cautious? Like, what's kind of your outlook when you talk about staffing, Holly or Alex?
So today we're 30 people at Bridge Invest, 25 here in South Florida. As of right now, we're hiring 2 senior roles and 2 or 3 analyst and associate level roles. So it's a meaningful uptick for us of new hires. The idea there is just because of the volume of transactions that we're seeing, we just need more people to help us review that. Mm-hmm. So to the extent that we're finding more interesting candidates, we're certainly evaluating more. And I've been doing this for long enough to learn that if you have someone that's passionate about what they do and they want to come work with you, then you'll find a place to fit them in, and they'll be successful at that.
Yeah. Holly?
So I think it's always important as somebody who runs a company to have the staff be the right balance. And lending has been more challenging this year, so we're not hiring right now.
Yeah. And David, do you need more people to scout for deals?
I say soon. I still think if you look at transaction volume, depending on what metric you use, it's down something like 70%. So, when things start moving, we'll definitely expand and increase headcount. But I once again, is it middle of 24? Is it into 25? It's anyone's guess.
Yeah. All right. Well, Alex is definitely hiring now, so.
If anybody knows a good general counsel.
All right. Well, I want to leave it there, and I want to thank these guys.